The Japanese yen continued to be the weakest currency in an otherwise mixed week. Eurozone finance ministers finally finalized the deal for Greece's bailout, but that didn't provide the needed fuel for the euro's extension of its rally against the dollar. Meanwhile, overall markets lacked a clear direction, and have been volatile over fiscal cliff swings. European majors did try to resume a recent rally against the dollar but could not sustain their gains. Meanwhile, the Canadian dollar and Australian dollar were both range-bound. The dollar index was trapped in a tight range between 80.0 and 80.5. In other markets, the Dow suffered an intraday weak sell-off but managed to close above the 13,000 level. Gold dropped back to close at 1,712 while crude oil still couldn't find the momentum to break through the 90 psychological level. Technically, the downtrend in the yen is weakening as the December 16 election approaches. But as long as 81.68 in US dollar yen, 105.27 in euro yen and 130.45 in British pound yen hold, the near-term outlook in the yen will stay bearish. However, a break of any of the mentioned levels will be an early sign of bottoming in the yen. A similar picture is seen in the dollar and Europeans. The dollar would stay weak as long as 1.2879 in euro dollar, 1.5961 in British pound dollar and 0.9340 in dollar Swiss franc hold. But similarly, a break of any of these levels would be an early sign of bottoming in the dollar. In crosses, Euro British pound and Euro Australian dollar extended recent recovery but are both now close to near-term resistance levels and the risk of reversal is increasing. So considering all the factors, going Euro-Yen long is still the preferred choice initially this week, but we'd need to be very cautious as the week goes as the dollar and yen might bottom and the euro could top in crosses. The U.S. markets have basically been engaged in fiscal cliff swings last week as sentiment flip-flopped across the board. At the end of the week, President Obama warned of prolonged negotiations in resolving the issues. House Speaker Boehner was direct and said that, "There's a stalemate, let's not kid ourselves." Now there is just a month for Obama to solve the fiscal cliff issue. The Organization for Economic Cooperation and Development warned that, if the fiscal cliff is not avoided, a large negative shock could bring the U.S. and the global economy into recession. And there would be a significant drop in activity in 2013. The organization also said that, reducing the large federal budget deficit is necessary to restore fiscal sustainability, but this should be done gradually and in the context of a well-identified medium-term consolidation plan. It said that the pace of consolidation should be gradual so as not to derail the already weak recovery. The Fed's Beige Book suggested that economic activity expanded at a measured pace in recent weeks. Yet, Hurricane Sandy and concerns about the fiscal cliff were key factors constraining growth during the surveyed period. While the housing market fared better, manufacturing activities weakened with 7 districts reporting either slowing down or an outright contraction. Business owners explicitly stated that worries over the fiscal cliff delayed their business decisions. Eurozone finance ministers finally reached an agreement on Greece's fiscal consolidation and agreed that the disbursement of the next tranche of bailout funds would be done on December 13. The agreement reached by EU finance ministers includes a plan for Greece to lower its debt to 124% of gross domestic product by 2020 and below 110% by 2022. This was in contrast with the IMF's request of 120% by 2020, a reduction of interest rates by 100 base points on Greek debts, and an extension of the maturities of loans for 15 years from other countries and the Eurozone's bailout fund, and a deferral of interest payments by Greece on European Financial Stability Facility loans by 10 years. Greek Finance Minister Yanis Tayaras said that the bond buyback program will be launched early next week. The operation is expected to be finished by December 13, before release of the next tranches of bailout funds of €43.7 billion in 4 installments from December to March. Greece will need to spend around €10 billion from the European Financial Stability Facility to buy back around €30 billion of debt and thus lowering the outstanding obligations by around €20 billion. The European Central Bank said in its legal opinion it considers Article 127(6) of the treaty constitutes the appropriate legal basis for rapidly and effectively conferring specific supervisory tasks upon the ECB. That is, the treaty does allow the ECB to be the regional bank supervisor. And the central bank said that the so-called single supervisory mechanism should comply with 6 principles. Those include, firstly, not risking the ECB's reputation, secondly, maintaining independence, thirdly, strict separation between monetary policy and bank supervision, fourthly, having full resources to knowledge, expertise and operational resources of national supervisory authorities, fifthly, consistence with principles of a single market and a single rule book, and sixthly, comply with the highest standards of accountability for the supervisory tasks. The European Central Bank also said it expects to reach an agreement on supervision proposals by the end of 2012. From January 1, 2013, the ECB should have been handed the power to oversee all 6,000 Eurozone banks as part of the banking union. And operational implementation will gradually occur over 2013 with full implementation completed by January 1, 2014. The Bank of England warned in its financial stability report that progress by banks in raising capital has slowed and investor confidence remains low. And market concerns are likely to reflect in part uncertainty about bank capital adequacy. Also, it said that UK banks' capital buffers, available to cushion losses and maintain the supply of credit following realization of a stress scenario, are not as great as headline regulatory capital ratios imply. Though, Bank of England Governor Mervyn King said that the problem is manageable, and is already understood at least in part by markets. It was surprising that current Bank of Canada head Mark Carney will succeed Mervyn King as the Bank of England Governor from July 2013. It is difficult to predict the outlook of the monetary policy in the central bank under Carney. Paul Tucker was originally tipped as the leading candidate for the post. But it's reported that the LIBOR scandal undermined his bid and eventually cost him this top post. Yet, Carney has been regarded as an innovative, policy pragmatist. For instance, Carney as the head of the Bank of Canada introduced the conditional rate commitment in 2009. It was the first G7 central bank to have made such an arrangement. It would thus be reasonable to forecast that the Bank of England will be more aggressive in quantitative easing implementation under Carney, although he only has one vote, after all. Swiss National Bank President Thomas Jordan said that the Swiss franc at its current level still has a high value. And he noted that this burdens a lot of companies, especially in a phase of moderate global economic growth. Jordan reiterated that the bank will defend the Euro-Swiss franc 1.2 floor, with determination and is prepared to buy foreign currency in unlimited quantities. The floor would shield Switzerland from major damage, but he also warned that the minimum rate is a response to exceptional circumstances and is not a remedy for problems of any kind or an instrument to fine-tune the economy. Also, as the Swiss National Bank's balance sheet expanded 5 times since 2007, fluctuations in value may be much greater in the future than they have been in the past, creating substantial risks. The Japanese cabinet approved 880 billion yen stimulus package, more than double of an earlier package announced back in October. The package includes $132 billion for nursing homes, $100